Hello and welcome to The Explainer. Today we're going to break down a classic and frankly brutal bull trap. We'll use the market action from February 2026 as our case study to really show you, the retail trader, how you can start to spot these warning signs and, most importantly, protect your hard-earned money.
All right, let's jump right into the deep end. We're starting with the most dramatic part, the market crash on February 19th, 2026. This was a day that, wow, it really caught a lot of people flat-footed and taught a very painful lesson about how markets can turn on a dime. So on that one day, the Nifty 50 index just plummeted. We're talking a staggering 365 points. Now that's a drop of 1.41%, and it sent absolute shockwaves through the system, basically wiping out all the recent optimism in an instant. And to put that number into perspective, this wasn't just points on a chart. This catastrophic fall erased an estimated 7.5 lakh crore of investor wealth. That's about 90 billion US dollars just gone in a matter of hours.
So you got to ask yourself, right? How does a solid, confident 3-day rally just vanish? Poof, gone in a flash. Well, this wasn't some random fluke. This was the snap of a perfectly set trap. And to avoid the next one, you have to understand how it was set up in the first place. So let's rewind and see how this thing was built, piece by piece, in the days leading up to that big collapse. You know, every good trap needs some tempting bait. And in the market, that bait is usually a really convincing story, a bullish narrative that feels just too good to be true. Just look at this timeline. It's almost picture perfect, isn't it? From the 16th to the 18th, you have this beautiful recovery story playing out. A strong breakout, followed by steady gains, which convinces more and more people that the bottom is in. And then, the final twist. The market actually gaps up on the morning of the 19th. That's the ultimate lure, pulling in that last wave of FOMO buyers right before the floor completely gives out. Now let's look under the hood at the money flow, because this tells a really fascinating story. On the 16th, you see foreign institutions selling, but domestic institutions, the DIIs, they step in with huge buying power. Then for the next 2 days, both of them are buying. To a retail trader watching this, it looks like rock-solid institutional support, giving everyone this false sense of security. And that brings us to the really critical question of psychology. If the big institutional players were just setting the stage, then who was it that was rushing in to buy at the absolute peak right before the crash? By the time we get to the morning of February 19th, a classic market emotion had totally taken over. This quote just nails it. The fear of missing out has replaced the fear of loss. After seeing 3 straight days of green, people weren't afraid of losing money anymore. They were terrified of missing the next big move up. And you know what? The data backs this up completely. Right before the crash, retail investor equity flows hit the 99th percentile of historical records. Let that sink in. This means individual investors weren't just dipping their toes in, they were pretty much all in, showing an absolutely extreme level of bullishness. And this is where that dangerous split happens. You've got the sentiment buyers, the retail crowd, just fueled by FOMO, buying aggressively. And at the same time, you have the so-called informed money, the institutions, quietly using all that buying pressure as the perfect opportunity to sell their positions at great prices. A massive transfer of ownership was happening right in plain sight.
You know, analysts have a great name for this. They call it a relay race, and it's a classic pattern you see late in a rally. The smart money hands off the baton, which is really the baton of risk, to the retail public right before the market is about to collapse from exhaustion.
So what were the signs? What were the clues that a trap was being laid? What was the smart money seeing that maybe a lot of retail traders missed? Let's break down those telltale signs. The biggest, loudest alarm bell went off on February 19th itself. I mean, look at this data. For the first time in days, both the foreign and the domestic institutions became net sellers at the same time. The DIIs, the very group that was propping up the market, suddenly pulled their support. This synchronized selling, this was the moment the safety net was ripped away. Okay, so another really useful tool for checking the market's mood is the put-call ratio, or PCR. Now, in simple terms, it just tells us if traders are betting more on prices going down, those are puts, or prices going up, those are calls. It's often used as a reality check on market sentiment. And right here, you can see the trap in action. As prices started to tank on the 19th, the PCR also fell off a cliff. Now, that is a very, very bearish sign. It means the bulls were panicking and selling out, while the big, dominant players, the bears, were aggressively selling call options, essentially making huge bets that prices had absolutely nowhere to go but down. And finally, the price chart itself screamed confirmation. The index didn't just dip, it smashed through critical support levels, like the 20-day and 50-day moving averages. For any technical trader, seeing those levels break is like a giant red flashing light. It signals that the bullish momentum is completely dead and the bears are firmly in control. So, what's the key takeaway here? I mean, it's interesting to look back, but the whole point of this is to learn how to protect yourself going forward. Because make no mistake, these kinds of traps are a recurring feature of the market. So here are 4 crucial steps to keep in your playbook. First, watch those institutional flows. When the big players who are supporting a rally suddenly start selling together, you have to pay attention. Second, know your technicals. Know where those big resistance levels are before you even think about trading. Third, learn to be a bit of a contrarian. When everyone is screaming buy and FOMO is off the charts, that's the time to be cautious. And finally, and this is probably the most important rule of all, wait for confirmation. Trade what the market is actually doing, not the story you hope it will tell. So ultimately, this whole event leaves us with one powerful question. It's a question we should all ask ourselves before we ever click that buy button. Are you reacting to the clear, hard evidence the market is giving you? Or are you just trading based on the story you want to be true? The difference between those two things could be what saves you from the next trap.